Are the fees of a life insurance policy a total ripoff? How about an IUL or an Index Universal Life Policy? In today's video, I'm going to describe exactly what the IUL costs are in a policy, how they're calculated, and how to keep them as low as possible. Oh, and spoiler alert, I'm going to explain how they're a little bit high in the beginning of the policy, but then minuscule through the life of the policy. My name is Gail Longenecker. I've consulted to hundreds of entrepreneurs, executives, and engineers in the area of life insurance. For the best life insurance advice, subscribe to my channel here and make sure you hit that bell to be notified when I upload new videos. Now, if you're new to IULs, please use the other videos in my channel to kind of check out and educate yourself. You might really enjoy Tax-Free Retirement Part 1 and Tax-Free Retirement Part 2. That'll fill in a little bit of the background information you might need when we go dive into the numbers. So let's hit it. Let's start with the big picture. We have one client here who is going to start a retirement fund using life insurance. So here we have our client, and he's paying money into this life insurance policy. Right away, there's some fees that come out. You can see that, fees that are coming out. And the rest of the cash actually builds as accumulation value. You see that? And for this example in this video, I'm just going to say that it's a general middle of the road 6% interest credits, okay? So kind of like when you put your money in at the bank, it would earn an interest. Well, this is a similar thing. You put your money in with the insurance company, it's going to earn credits of 6%, and we'll see that in a little bit. Okay, all the while he's able to do that, okay? And the insurance piece of this is he has a tax-free death benefit for his beneficiaries. So if anything happens and he dies in the meantime, he's going to be able to have a death benefit for his children and his family. So in this case, he was 32 years old. He put $20,000 in for 30 years, and he had a death benefit of $800,000 that we were able to start with. And all the while, as the cash bucket builds up here, he's going to have cash via available loans or any withdrawals for any financial needs. I'm going to highlight loans there because that's more advantageous for him than withdrawals, but either are possible. Now let's start out with these policy ledgers, okay? So remember, our client is putting in $20,000 every year until it's time for him to retire. Okay, the first year he's got total policy charges of $3,481. Oh my, isn't that a lot? This is where people come to say, gosh, these policies are so expensive. I'm going to take 3,481, I'm going to divide by $20,000, and I get 17%. That is very expensive, but we're going to show you why it's not as I uncover the layers of the onion here. But anyway, let's tear apart and get into detail. What is this 3,481 made up of? First of all, it's a premium charge of $1,600. So a premium charge, if you think of sales tax, just like when you go to buy some shoes at a store, there's a sales tax that's added to the cost of the shoe. So in this case, it's kind of like the tax that's paid to the state. In this example, we start out at 8%, and then it drops down a little bit in year 11 at only a 4%, I'm sorry, year 10. At only 4% tax. And this is only taken or charged to the policy when there's a premium put into the policy. So after he puts in his premium for 30 years, then this premium charge goes away. This policy fee is $7.50 per month times 12 months, and it's a whole $90 per year. No big deal. This lasts for the life of the policy. No big deal though. This per unit charge is a little confusing, and it might be somewhat what people would say, gosh, they're hiding a lot of money in that. That $1,000.09 is set up to be basically two or three things. First of all, the underwriting. So the team of people that had to actually put this policy in place and make the decisions. What are the risks? What are the policies? What are the fees? And all the decisions that have to go into create this policy and this tax-free income for this particular client. It also includes the medical charges, like the medical exam charges, and the agent commissions are in there as well. Now this doesn't last forever. This goes for the first 10 or 15 years. So then after that it peters out and it's zero. Cost of insurance will never go away though. This is the cost of insurance for this particular 33-year-old male who's in good health, not excellent, but just good health, in order to purchase $800,000 of death benefit. It will continue for the life of the policy up to his age 100. After that, age 100 to 120 is completely free.
There's no cost of insurance to carry that death benefit. But as you can see, it increases a little bit every year simply because we get older every year. Oh, look, it's about the same there. There's a little pocket where it's the same, and then it increases later on. So this cost of insurance will always be a fee to the policy. Now, those are things that you always will be charged. These last few things I'm going to talk about are optional. The rider charges mean it's just an option on the policy. If you chose a rider or an option, like for example, you wanted to insure your children with a death benefit as well, or if you wanted to guarantee a certain death benefit at a certain age, some of those little bells and whistles cost a little bit, and it's put into this rider charge bucket. For simplicity, I didn't put any riders on here, so there's no rider charges or rider fees. These asset charges with this particular carrier are considered the multiplier fee, if you've heard me talk about that. With our index credits, we can have a multiplier on top of it so that our 6% would be multiplied by 1.5, for example, so then we get 9% back. Well, there's a charge to be able to do that multiplier, and those would be thrown in this particular bucket here. Okay, so if I add up my 1,600, my 90, my 1,009, and my 782, I get 3,481. Okay, but don't fret. Please don't fret. Let's move on. What happens? What's the good news here? I'm going back down. This is called policy credits and charges for this particular carrier. Oh, look at that. 3,481 in year one sits there under policy charges. But look what happened. Interest, loan, and credits. So this $1,204 actually came because our $20,000 less the fees times 6% compounded actually gave us a positive interest of $1,204, okay, less our policy charges. We're going to ignore loan charges here. That gives us an accumulation value of $17,724. Isn't that awesome? Oh, but what is this? This cash value is only $1,308. That's a problem. I'm going to talk about that in a minute. And all this is to support the death benefit here. It started at $800,000. By the end of the first year, it's $812,000, and it's just growing. You can see that growing for quite a while. It's nice and healthy. It's $1.2 million here after the 15th year. Okay, after the 15th year. Nice. Okay, so let's go back to this accumulation value versus cash value. So what the insurance company wants you to do is they want to incent you to stay in the product and keep your money there. They don't want you ditching or canceling or withdrawing from the product. So if you notice all the way down here until year 12, these are different numbers. But in year 13, I've got $356,000 and $356,000. So my accumulation and my cash value is the same. The difference here up until year 13 was the surrender fee. So if you cash out this policy after year 5, you're going to have quite a difference here. And so you would only have your walkaway value of $85,000, even though the contract or the policy holds $101,000 of cash. So the difference there is your surrender fee. You never pay it. And what I always tell my clients is just stay in this for the long term. After 15 years, you won't have to, after 12 years, you won't have to worry about a surrender fee. Okay? So the good news is this policy charges is of 3,481 was what? That's 17%. However, it earned a 6% here. So in the beginning, the fees are a little bit more. But now look down here. Let's go to year 6. I've got $100,000 in, $120,000 total. You see that? I've earned $8,000 and I still only have $3,000 of fees, so I'm coming out ahead. What's happening is my accumulation value is just growing and growing and growing. My fees don't grow, they stay about the same, $2,000 to $3,000. And so over time, as the contract and the cash value and the cash account and all those index credits are growing and growing and growing, my fees remain stable, so my total percent of fees is getting lower and lower and lower. So look at this nice chart. Okay, the orange and the green represent the fees charged to the policy. So these policy charges, which are the things like the premium charge, remember that sales tax, as well as the policy charges, the $7.50 per month, as well as the underwriting charges, the medical fees, and the agent commissions are all in there. Okay, so that's the pink section, and then the green section is the cost of insurance. We know that never goes away. And so we can see this green, it's pretty high in the beginning, and then it continues. You can really kind of barely see the cost of insurance there. And this is a percentage of the net surrender value, okay? So at the age of 62, gosh, there's like nothing to represent there. I want you to pay attention here. It's 0.19%. So your total fees are 0.19% of the full net surrender value. That is nothing, folks. Most people are used to paying a 1% of asset under management, or AUM, fees to their financial planner. So we can come in at 0.19%, which is 1/10 of an AUM fee. That's really exciting. But even back here, right, I want you to, let's see, watch this total percentage point as I go this way. And I'm going here 0.2. If I go earlier in the policy, 0.57, 0.83, 1.27. So we really can't knock it here. And as we go out past the age of 62, so inexpensive over time because our cash value is growing. We're earning credit interest and index credits, and our fees are, as a percentage of everything, very low. Okay, so I really like this chart because it shows us just how minimal the fees are, especially over time. So this is something, it's a long-term product. You want to get yourself in early and healthy, and then use it and really leverage your funds inside of a tool and a policy like that.
In my next video, you'll learn all the ins and outs about cash loans versus withdrawals from your life insurance policy. So stay tuned for that one. Your wealthy investments should include an IUL policy. So let's be sure that what we design is going to serve you best. Just click on the link below to learn how to become my client. Together, you and I can develop a cool, custom, interactive chart, just like what you saw in today's video. Thanks for watching, and remember, I'm in your corner, helping you to build wealth your way.